Hello traders, you are welcome back to the Forex Geek channel. If you are looking to level up your trading strategy, you are in the right place. In this video, we are diving into a powerful concept known as correlation breakdown trading. Now, this strategy can give you an edge in the market by helping you identify when correlated assets stop moving together, creating opportunities for profitable trades. Before we jump in, make sure to hit that like button and subscribe to the channel so you never miss a new trading strategy or tip. Now, let us break down correlation breakdown trading and see how you can incorporate it into your trading routine. So, what exactly is correlation breakdown trading? In simple terms, it's a strategy that takes advantage of when assets that usually move in the same direction start moving in opposite directions. For example, you might notice that two currency pairs or even a commodity and a stock typically move together. This relationship is called a correlation. When two assets are highly correlated, they tend to follow the same general price movement. However, when that correlation weakens or breaks, it can signal an opportunity for traders. This breakdown means that one asset might continue in its current direction while the other might reverse. This creates a unique trading opportunity to capitalize on the change. For instance, imagine Euro USD and GBP USD Imagine Euro USD and GBP USD have been moving in tandem for weeks. If suddenly the Euro USD starts moving up while the GBP USD starts moving down, the breakdown in correlation could indicate that something significant is happening in the market and it might be time to make a move. So now you might be wondering, why does correlation breakdown even happen in the first place? Well, there are several factors that can cause the historical relationship between two assets to weaken or change. One of them is economic events. News, central bank decisions, or geopolitical events can affect the relative strength of two currencies or assets. For example, a major policy change from the European Central Bank, that is the ECB, could impact the Euro USD, while at the same time, an unrelated event might affect the GBP USD, leading to a correlation breakdown between the two pairs. Secondly, we have market sentiment. When investors or traders start to feel more bullish or bearish about a particular asset, it can cause them to make decisions independently of correlated assets. This can create a sudden disconnect in price movement, opening the door for a potential trading opportunity. Now, talking about technical factors, on a technical level, a sudden shift in the chart patterns like a breakout or reversal in one of the correlated pairs can also trigger a breakdown in correlation. For example, if a trend line or key support, right? For example, if a trend line or key support level is broken, it could lead to price movements that no longer match the usual correlation. Okay? So how do you spot a correlation breakdown? There are a few methods you can use to identify when the relationship between two assets starts to weaken. The first is historical correlations. The first step is to analyze the historical correlation between the assets you are interested in. Platforms like TradingView or MetaTrader have built-in correlation tools that can, allow you to compare the movements of two assets over time. If they've been moving in sync for a while and suddenly start diverging, you've got a potential correlation breakdown. Now you can also monitor divergence. Once you've identified two correlated assets, you can keep an eye on the price movement. If one asset moves in the expected direction but the other does not, this divergence could signal a breakdown. The greater the divergence, the stronger the signal. Now, using technical indicators, there are several technical indicators that can help you spot a correlation breakdown. For example, if one of the correlated assets is showing an overbought or oversold condition on the relative strength index while the other one doesn't, this could signal that the correlation is breaking down and a trading opportunity is emerging. Finally, look for key levels. Okay, sometimes a correlation breakdown becomes evident when one of the correlated assets breaks through a key support or resistance level while the other asset stays within the range. This can indicate a shift in market sentiment or fundamentals, potentially leading to profitable trades. Now, once you've identified a correlation breakdown, the next step is executing a trade based on this newfound insight. For your entry point, if you notice a breakdown, it's often best to wait for confirmation before entering a trade. This could come in the form of a price action signal such as a candlestick pattern or technical indicator crossover. You don't want to jump in too early as the market may correct itself and re-establish the correlation. Okay, secondly, your trade size and risk management is important. When trading based on correlation breakdowns, it is crucial to manage your risk carefully. A breakdown doesn't always guarantee a strong move in the direction you expect. So use smaller position sizes, set tight stop losses, and ensure you're comfortable with the potential volatility. Then for your exit strategy, as with any trading strategy, having an exit plan is key. Look for signs of the correlation starting to re-establish itself. This might include both assets moving in the same direction again or a major reversal in one of the assets. At this point, it might be time to take your profits or adjust your positions. Okay? So now just a scenario, right? An assumption. Okay, so let us say that the Euro USD and the GBP USD are typically highly correlated, which they are, right? Meaning they move in the same direction most of the time, which of course we can see happening. But then imagine if something happened unexpectedly and the Euro USD starts climbing higher, but the GBP USD starts moving lower. This sudden breakdown in correlation could indicate that the Euro USD might continue its bullish trend while the GBP USD could start reversing. If you identify this pattern early, you could enter a trade on the Euro USD expecting it to continue its upward movement while the GBP USD could continue downward. This kind of trade can give you an edge in understanding market shifts before they become widely known. Now, to wrap it up, correlation breakdown trading can be a very effective strategy when used correctly. By understanding the historical relationship between assets, monitoring for divergences, and executing trades with proper risk management, you can anticipate on these opportunities. You can capitalize on these opportunities and make smarter trading decisions. If you found this video helpful, don't forget to hit that like button and subscribe to the channel for more trading tips, strategies, and insights. Thank you for watching, and I'll see you in the next one. Feel free to drop any comments or questions in the section below. I'll love to hear how you are using correlation breakdown trading in your own strategy. Happy trading.